Hello everyone, welcome to our discussion of Chapter 4, specifically the PowerPoint slides that go over the main points for Chapter 4 to help us understand. So I want to start because we're talking about deductions for AGI. These are special deductions that are going to reduce AGI. Remember we talked about AGI in Chapter 2 as an important intermediate step that has influence on other deductions. We've already run into a couple of situations where a deduction is phased out or a tax benefit is phased out based on AGI. So if AGI goes up, not only does it increase our taxable income in that way, it also affects other and may reduce other tax benefits. Okay, so these are very much like the things that we talked about in Chapter 3 that are exclusions for gross income. But they're going to be listed. They're actually going to be deducted from gross income to get AGI. They're put on this schedule, okay, separate from the 1040 and then taken over to the 1040 in one amount, you might say. And so I've reproduced the part of the schedule that lists them all. And just to give you an idea of what we're talking about, where they go. And we're going to go over most of these, not necessarily in the order that they are on the form. We're going to not talk about this one. And notice the one with the big circle, certain business expenses of reservists, performing artists, and fee-based cabinet office officials. This gives students sometimes a kind of heartburn, and because they want to deduct this on Form 2106. The point being, though, this is a very, very narrow. It used to be broader. There used to be more people involved, but now the 2106 only, okay, has to do with certain business expenses of reservists. That means people in the Army or Navy Reserve, performing artists, so people who sing and dance, things like that, and fee-based government officials. So a very limited thing, and so we are not going to review that. So those business expenses and the Form 2106 is not going to be something we cover, and you're not going to see it. Don't try to make it work in your homework. We are going to do the educator expenses, health savings account deductions. We're going to do moving expenses, but notice that it's been made much narrow. It's only for members of the armed forces. It used to be for everyone if they moved to take a new job, but now it's only for the armed forces. We're going to talk about self-employment tax. We're going to not talk about SEP and simple plans or the IRA deduction. Those are going to come back, and we're going to talk about those in Chapter 11. We will briefly go over the self-employed health insurance deduction, penalty on early withdrawal savings, alimony, student loan interest, okay, and then the Archer MSA deduction is essentially the same as the health savings account. If you didn't switch to the health savings account, you could still be doing it this way, but the thing works about the same. And then there's some really minor things down here on line 24, and all these A, B, C, D that we are also not going to deal with just because they have such limited application. So we try to not overwhelm you with lots of things that are not going to come up very often. The first one, student loan interest, is very common. Okay, and perhaps most likely why we are going to talk about it first, because it's probably one of the most common ones. Okay, so first thing we have to decide is it a qualified student loan? Okay, it has to be incurred by the taxpayer to pay qualified education expenses. So it doesn't say who you have to borrow from, but the money has to be used for qualified education expenses, and that's limited, okay? We're talking about things on the next slide as to what those will qualify as, okay? On behalf of the taxpayer spouse, or any dependent of the taxpayer at the time the loan was incurred. So again, back to that definition of a dependent that we talked about back in chapter 1. The deduction is limited to $2,500 per year. So if you pay $3,000 in student loan interest, it is still limited to only $2,500. The maximum is $2,500. It doesn't matter how much you pay. Okay, so that's the first limit. Well, I guess the second limitation. The first limitation, it has to be for a qualified education loan. Okay, and the pay the expenses for this limited number of people. And then the second one is it's $2,500 maximum that we can consider. Okay, a little bit more about what is qualified education expenses. Cost of attendance at an eligible education institution. Usually they accept financial aid is the definition. Tuition fees, books, supplies, equipment, room, board, and transportation. Not all places in the code that talk about qualified education expenses include room and board. Most of them don't, but this one it does. So if they got a loan to pay for these qualified education expenses, then the interest on that loan is deductible in this way. All right. So it has to be within a reasonable period before or after the loan date. Okay, and then it has to happen while you're carrying at least half the normal full-time workload. Okay, so basically eligible for financial aid. It doesn't matter what level. It can be undergraduate or graduate level. And then we have another restriction. Okay, the deduction for student loan interest expense may be limited based on AGI. We already talked about that, okay? So before, as it says, modified, before any deduction for student loan interest and any income excluded from taxable income because it's out of the country, or the deduction for tuition and fees, which is no longer happening, or domestic activities production. Again, not very common. So for most places, this is AGI, but before you consider any student loan interest. Okay? So what is the threshold? Well, on a joint return, it's $155,000 is when it starts disappearing, and it goes away completely when your adjusted gross income is over $185,000. So you've got a $30,000, okay, window. If it's less than 155 for a joint return, then you get the full 2,500. But if it's between 155 to 185, it phases out. You get part of it based on where you are in that range. The higher you are to 185, closer you are to 185, the less of it you get. Same thing for single returns, okay, 75 and 90, okay. So you see that the range is only 15,000. So how do you calculate that? Take the preliminary deduction. Remember, it's limited to 2,500. How much interest you pay, qualified. You then multiply by the fraction, and this is calculating the disallowed interest. So you take what their modified AGI is. If it's under 155, you don't have to worry about it because there's no reduction. But if it's over 155, you take that. If it's over 185, you don't need to bother making the calculation either. But if somewhere in between, okay, it's 175. You're going to take 175 minus 155. That's 20,000 divided by 30,000. That's 2/3 or 67% or so is going to be disallowed. So if you had $2,500 of preliminary amount of interest to deduct, and then you would reduce it by 2/3, and you'd only get to deduct 1/3. Okay, it works the same way with single taxpayers, except you got a $15,000 window or range. Okay, so that's student loan interest. So it's a common deduction because a lot of people have student loans, but it has multiple restrictions that you need to know. Okay, and again, it is for a 4 AGI deduction. Health savings account, like the student loan interest, this is becoming more common, although most of the ones that I see are through an employer, and so it doesn't really show up as an account deduction. The employer pays for it, and therefore it's just not included in your income on your W-2. But absent that, a health savings account is a tax-exempt savings account. You put money into it. The deduction is for how much money you put into it. Okay, for qualified medical expenses, it can cover yourself, your spouse, and dependents. Again, same definition. Okay, for contributions to the HSA. All right. Now, this can be through your employer, or it could be a type of account you set up because you're self-employed or you have no coverage at your employer on your own. So to be eligible for this, a HSA, to be able to use this special savings account, all right, then you must have a high deductible health plan, either yourself, okay, or through your employer. Okay, so you either buy, and this high deductible plan has to be, so you have the savings account and you have this plan. You can't have the savings account unless you have this high deductible plan. All right, and the individual can't have other coverage, okay, or health insurance except for special coverage for accidents, disability, dental care, vision care, long-term care, workers' comp. Workers' comp doesn't make it, even though it covers some health costs, is not considered an insurance to disqualify you from having. So basically, you can't have a whole bunch of health insurance plans and still have a health savings account. You have to have the one high deductible health plan. You can have others for accidents and disability and dental, but for your actual health insurance, you have to use this combination of an HSA and a high deductible plan. So what does a high deductible plan mean? Well, the law tells us specify minimum deductible amounts. So it has a high deductible and a maximum deductible and out of pocket. So the most that you would have to pay in any given year under the plan. So for individual coverage, you'd have to have a deductible of at least $1,500. It can be higher, but it needs to be at least $1,500. But then it can't have you pay more than $7,500. Meaning between the time that when you consider the deductible amount plus whatever co-pays you pay. So, for instance, if it's a deductible of $2,000. And then you pay 20% of everything after that, and the insurance pays 80%. That 20% has to go away once you reach the $7,500, meaning that you can't go more than that. So that's the type of plan it has to be. It has to have two things. It has to have a minimum deductible amount and a maximum out-of-pocket cost, expensive cost, okay? So if you have that, then you can put money into this HSA, okay, and contribute to or withdraw from the HSA, and it's all reported on a Form 8889. Send it in and file it with your 1040, okay? And contributions, as long as you make the limitations are met, okay, you can make the deduction, okay? And then the real cool thing is distributions are tax-free as long as they're paying medical expenses. So it has the result of making medical expenses deductible even if they aren't very high. And we'll learn later that medical expenses for itemized deductions are only deductible if they're very high. So this is a way that can be a reduction in your AGI if you do it correctly. You can't just put a whole bunch in there. Okay, there are limits to the contributions, okay, that you can put in a given year. There's a maximum. And that includes if your employer puts money into it. So you have to also pay attention to that. Don't want to exceed the maximum when you add to it what your employer put into the HSA. So these health savings account cannot just be a normal account. They have to be set up with an insurance company or a bank. They have to be a trustee. Very similar to a retirement plan. They have to have a control, and they're going to report back to you what they, okay, what you spent, what they got in, and what you requested to be paid out. Okay, and that is what the custodian or trustee does, and to make sure that the money is used for the right things and that it is kept, you might say, safe until that happens, and that you don't go over the maximums, that sort of thing. All right, moving expenses. These only apply to active duty members of the U.S. Armed Forces, but also their families. Okay, so it's the whole family that needs to move. Okay, if this is the case. Okay, permanent change of station, move from one permanent post to another, last post. Okay, that sort of thing. These are the things that have to be satisfied for someone in the military to be able to deduct moving expenses as a Ford AGI deduction. Okay. If the government provides it to the person moving, then it is not income. Okay. So if the amount says the dislocation allowance, temporary lodging expense, all that type of thing, that's income that the military can pay to the family without it being reported as income. So it's left out of AGI. Okay. Unless, of course, there is a reimbursement that's higher than their actual moving expenses. Okay, then it becomes wages. Okay, reimbursements for various things exceed. Okay, must be on the W-2. As long as it's the amount that the actual move costs, then it is excluded. If there are things that are not reimbursed, then they can be deductible for AGI. Okay, so you can't do both. If you get reimbursed, you can't deduct it. Okay, but they may not reimburse all of the expenses. So storage of household goods, 30 days. Okay, moving expenses for the rest of the family, part of their household, that may not be reimbursed. That cost of them getting there. If they have to fly, or if they have to have a bus ticket, or if they have to drive. If they drive, okay, the car expenses are calculated. You can figure out what exactly the out-of-pocket costs of gas and oil, but that seems very difficult. So they give you a standard mileage rate for 2023, and this is just each year based on the cost of operating a vehicle, 22 cents for every mile. So if you look at where you're moving from to where you're moving to, calculate the miles, okay, and then you can deduct 22 cents times whatever those mileage are. Okay, on top of that, if you have to pay any tolls along the way, that's an addition. If you have to park somewhere in a commercial lot and have to pay for that, that's an addition. What is not added to that is meals, okay, or any extra miles to go on a side trip. Lodging can be deductible, but not very expensive lodging. Okay, then there are also the foreign moves, okay, that may also entail a broader array of expenses. Okay, so remember that moving expenses, the rules are kind of similar to what they were for everybody. Now they only apply to the military. All right. We promised some discussion of self-employment tax. All right. Now, this is a little bit out of place in the sense that we'll get much more in depth in self-employment income and business income in Chapter 6. But for now, what you want to know is that if you have a business and you're self-employed, you pay self-employment or FICA tax 15%, 15.3% of net earnings from self-employment. So you take what you bring in if you're a business, your side hustle, whatever you want to call it, you subtract out the expenses, then you take that amount and you multiply it by 0.9235. Okay? When you do that, you are taking a deduction for half of the self-employment tax. Once you've done that, after you multiply by the 0.9235, you multiply by 15.3% or 0.153, and that is your self-employment tax. It's a one rate. You don't have to worry about different tax brackets. Okay? When Chapter 6, we'll learn that goes away when your income reaches a certain level. But right now, we'll just apply that. Okay, and that's calculated on Form SE. We have one, self-employment, S-Form SE, makes sense. It's filed with your 1040. So that's an additional tax in addition to the income tax that is often calculated on the 1040 and paid with the 1040. So that's why we bring it up here. And because half of it is a deduction for AGI. So once you calculate your self-employment tax, you take half of that, and that goes on as one of the adjustments to get to AGI. So the end result is that's half of 15.3% or 7.65% if you want to figure it out that way. Okay? So while talking about self-employment, and again, this is somebody who has a business that is considered self-employed, these individuals may also deduct 100% of their health insurance if they have to pay it as a self-employed person. Okay? So, limited in two ways. Okay? First of all, you can't take a deduction for more than the amount of income the business makes. Okay, so if your business isn't making much money, this might not help you. If you're just getting started in your new business, then you're paying your health insurance through the business to cover yourself. That might be more than what your income is from the business, and therefore you could only deduct the amount up to what the business makes. So it could be limited that way. The second thing is you can't have health insurance availability elsewhere. So if you have a job and you have a side hustle, okay, if you have health insurance through your job, even if you don't want to take it, if you don't want to pay for it, you cannot take the health insurance, self-employment health insurance deduction against the income from your side hustle, okay, because you have other insurance available. Okay, as long as it is subsidized in any way. Typically, if it's a group plan through your employer, it's going to be cheaper. It's going to be subsidized in some way. And you have to check that every month. You can do that a month because if you were at a job for 6 months during the year that had health insurance, you would be not able to take the self-employed health insurance for those 6 months. But if you then quit that job or left that job or were fired from that job, then you could be eligible for the other 6 months of the year to use the self-insurance health insurance deduction. All right. Now, this one Doesn't come up real often either. It's also usually a fairly small amount. Okay. But if you take money out of an account, if you buy a CD at the bank, that's me. You're putting a deposit in, and what you're agreeing to is that you're going to leave it in there for a certain amount of time. And if you decide, I got to have that money now, and you pull it out, you're going to have a penalty. That is a deduction for AGI. Okay? It'll be reported on your 1099 INT, and you'll be able to use that on return. It's usually, unless you have a lot of CDs, not a large amount, but it could still be helpful. Alimony. The law changed a little bit, okay? And if any alimony or any divorce agreement after 2018, alimony is not deductible or included in income. But if the agreement happened before 2018, which means there's lots of them out there that are still in place, right? Because they usually stay in place for a long time, and they haven't been modified substantially, okay? Then it's treated the old way with alimony, and the one that pays it gets to take a deduction for AGI, and the one that receives it includes the alimony as AGI. Okay? So, first of all, we need to know when the agreement was. Just know if this applies. If the agreement was made or changed substantially in 2019 or later, you don't have to worry about it. If before that, then you have a challenge. Okay. Now, when you know that there's payments and it's according to an agreement that's previous to 2019, there are three types of money that can go between ex-spouses in a divorce agreement: alimony, child support, and property settlement. Prior to 2019, only alimony had a tax consequence. Okay? They have to qualify as alimony. So they have to be designated as such. If they don't in the agreement, then the thing is you have to look at whether it is treated like child support, meaning child support is something that may be specifically stated in the agreement, but it also may be something that ends when a child reaches age 18 or 21. If a payment that one spouse is making to another is only until the child that's living with the other spouse reaches 18, it's child support. It's not alimony. Okay? No matter what they call it in the agreement. So we have to first of all look and see what it is. Property settlement is when we kind of divide up the assets and sometimes that can be in cash. For instance, the house. Let's say one spouse wants to live in the house, but only entitled to half of the house, you might say. So the other spouse might pay them in cash. That's a property settlement. The dividing up of the house without dividing it. If you sell it and divide up the money, that's one thing. But if you want the house to not be sold, then one of the spouse might have to pay the other in cash or some other way to make up for getting the whole house when they're only entitled to half of it. Okay? Now, besides that, alimony has to qualify as alimony and be deductible to the payer spouse and included as income for the receiving spouse. It must be in cash. It must be according to the agreement. Okay, so can't just be whatever they want to pay. It has to be in writing in the agreement. Okay, and the payments must end at the payee spouse's death. The one receiving it, when they die, it has to end because it has to be support of them, regardless of the age of the children, regardless of whether there is a mortgage on the house or any of those types of things. It has to end with the receiving spouse's ex-spouse death. That's what makes it alimony. Okay? So, The recipient of the payments must include these payments as income, included in AGI, okay? And the one that is paying it gets deducted for AGI. Now, if there are some shenanigans going on where the payments are higher in the first year and much lower in the second or third year, then they may have a situation where the IRS can disallow it as alimony and say it was a property settlement, because look how much extra cash was given right after the divorce compared to subsequent years. So this is only going to come into play if there's a substantial difference in the alimony paid over the years. If it's the same amount, you don't have that issue, and that's most of the time that's the case. Okay, the first one listed on the form we looked at was educator expenses. Kind of one of our last ones here to talk about because it's not a very big amount. Tends to be, while fairly common, it is restricted and it's not really that helpful because it's not very much. Okay, a high amount. You can deduct up to $300 qualified education expense for IGI only if you're an eligible educator. Okay, if you're filing jointly, you can do $600 because you got two people. Okay, if they're both educators but neither spouse can deduct more than $300 of their own. Okay, so they both have to spend the money and be able to prove that. So who's an eligible educator? Who does this apply to? Well, it's pretty narrow. Okay, teacher, instructor, counselor, principal, or aide in the kindergarten through 12th grade. So college professors, not educators for this one. Okay. Say K through 12, and they have to spend at least 900 hours in the school year. So if you're truly a teacher in K through 12 school, you're not, obviously the 900-hour test is going to be easily met. If you're a part-time aide or something like that, maybe not. Okay, and it's calendar year, the deductions have to be paid, the amounts have to be paid out. So you're buying supplies for the classroom that the school is not reimbursing you for. That's what this is for. Okay, and this is what's listed here: books, supplies, equipment, computers in the classroom. Pass the special law, expand it to PPE, disinfectant for the pandemic. Probably not as big a deal now. But the expense must also be ordinary, necessary. For $300, it's not going to be an issue. But if your employer is not an educational, and you take this deduction, you're probably going to get it challenged. Okay, if you are one, the chances of them saying anything about it or wanting to see exact receipts is pretty low, but you should be prepared in case that were the case.